So, have a bunch of things to roll through here for you, hopefully pretty quickly. It's a strange time in the world. It's a strange time in markets, and I thought of how do I try to sum this up, having seen all I've seen in 4 decades or so. Uh, I guess I common denominator for me is this. Uh, when the leading world peacekeepers are the Pakistanis, uh, or the nation of Pakistan, that kind of tells you the point that we are at. Uh, you know, I don't know what to believe. Um, I know what to trade, and what I'm trading is very, very, very small quantities of just about everything. And I put something out yesterday in the Daily Roar. A few things we're trying to do with those extra pieces. Um, One of them uh, was just a little taste of what I'm doing in some of my trading accounts. I mean, a really tiny one. I literally force myself. I give myself $1,000. I don't know if I told you the story, but back in my advisor days, had a client that, I mean, the guy was a billionaire. I'm quite sure. Uh, he didn't have nearly that much with us, but we were one of his go-to money managers, and um, he had one account that I guess he couldn't add to. I can't remember what the purpose was, but it had like $17,000 in it, something like that. So we agreed, okay, we're going to make this like the go for it account. And then, we had, I can't remember which market crisis it was, but one that really, took things down quickly. I mean, it might have been early 2020 pandemic. I can't remember. I think it was. And that $17,000 account, I turned it into $153,000. Now, why is that significant? Because it's exactly 9x. Exactly. Do the math. Um, don't know if I'll ever do that again, but it just goes to show you, like this is the era of you take care of all the priorities, okay? Don't lose big or figure out what your max loss is. And we're bringing all this together, just so you know, into this sort of build a portfolio type thing. We may call it that, we may call it something else, but within the roar.pietrade.com site, as we prepare to put a lot of it behind a paywall, frankly, pretty soon. We are going to really focus on allowing people to learn a little more about themselves. And then once they have that down, try to walk that toward, okay, here are things you can do. So, in terms of portfolio construction. And as you'll see in the new look, lighter version of roar.podtrade.com, which, by the way, if you like the dark, you just do that. Now you're back on dark. They just told me that like 5 minutes ago in an email. I said, "Hey, I love the white background, but what if somebody wants dark?" So, anyway, it's all there. Kind of amazing how quickly they're able to do this. I mean, if I was excited about this thing when we first debuted it, triple excited. No, I'm 9 times excited to go with that other crazy story. So anyway, that's a little introduction. What I don't think is an emotion that many people should have is this one that I just happened to see a little while ago from wallstreetjournal.com. Uh, hey, traders on pins and needles. Okay. Who knows? Okay. And this is before what happened late in the day and whatever. It's again, set up your core. Uh, which for me is a bond ladder, Roar 10 ETF portfolio, a little bit of SPY collar, actively managed. Okay, I know that there's a limit to how much the bottom can drop out of those strategies, and then say, okay, whatever is left, if I feel like spending the time, uh, try to take some big shots with small amounts of money. That's what the rest of it is about to me in this environment, because it is giving us those opportunities. Um, they are high risk, high reward. But again, for me, I took $1,000 and tried to figure out, okay, how much can I try to make on that? And it will fluctuate up and down because there's lots of leverage being used. I mean, this is what I wrote about yesterday. The T triple Q, which is the three times levered Nasdaq 100 ETF. And I mean, I've already cashed out and rolled one of those to try to make a little bit more. I mean, it's yeah, I wouldn't call it frenetic because it's all pretty disciplined, but I'm just saying, if you want to go beyond the usual, I think the environment is getting friendlier to that because it's so much simpler. Simpler in that. My guess is when I look back and review market activity today, and I go back to things like, well, what happened in the last hour of the day? Oh, the markets went up. Great. What happened to most stocks in the S&P 100? Bet they went up. Bet it wasn't like a mixed bag, okay, unless there's some kind of quick and reversible shift into consumer stocks or into energy or out of energy or whatever. Okay. In other words, this is not a market of stocks anymore. Uh, and the stock market, the bond market, the commodity market, gold and oil, and some of the others, it's all tied together. It's just risk on, risk off. And I've been writing this, but I don't know if I've said it plainly enough. But that's what it is. And like I said before here, I'm going to go over the updated 10 ETF portfolio, but I wonder if the proper number going forward is going to be between 2 and 10, depending on how well you want to try to do in down markets. Because if you only have two ETFs, if one of them is cash and the other is equities, unless you're going to do something a little fancier than that. So, look, I wouldn't say I'm frustrated because I'm not, but I am definitely annoyed by the fact that the markets look like they're moving further and further toward what I've been talking about for probably 2 years now, especially the last year with this group especially, is that it's all narrowing down. And what does that do? It makes it so that a lot of stock picking is just really overrated. I have been doing some work for a fellow ETF site, and I'll show you just a quick snapshot of that because I think there's something relevant in there. And but really, I think you know simple, but with a complex mechanism behind it, which is, I mean, for me, Roar score and just being conscious of the fact that this stock, this sector, that sector, for swing trading, which I do plenty of, great, great. But in terms of sustained market movement, you almost have to think to yourself, is almost everything that goes on deeper down in minutia of the markets can probably be tied directly back to what's going on in one of those 10 ETFs, whether it's the commodity stuff or the equity stuff or the bonds, the long and the short, et cetera. It all just ties back. I probably should do some sort of I don't know if you ever heard of the Kevin Bacon game. where he's been in so many movies and with so many actors that there's actually a board game about the connections he has. It's kind of like he's always like 2 or 3 or 4 degrees of separation from almost everybody in Hollywood. Actor Kevin Bacon. So anyway, I think that there may be the same type of thing going on now, and as a result, it's going to lead a lot of people to mislearn, misunderstand, get miseducated about investing. I'm not trying to say it's simple. I'm trying to say that people make it unnecessarily complicated. And to me, anytime I put money to work, my hard-earned money, just the way you would think of your own, anytime I put money to work, I want to try to have a positive outcome, whether it's something I'm buying or something I'm buying to hedge the other stuff that I own. So anyway, I wanted to kind of get that out there. This pins and needles stuff, I'm not worried about that. If you play offense and defense at the same time, as we try to do here, and you build a tool set, which boy are we building, then you've got a lot of insulation from a lot of this stuff. And look, I'm front and center to this, okay? Because remember, I don't, advise 30 something families anymore like I did for decades. I technically speak to everybody. I mean, the bar chart audience is huge, hundreds of thousands, I think, and Seeking Alpha and Substack. I mean, it's a big audience out there. But I feel like people are just instinctively going down way too many rabbit holes uh, because nobody is telling them otherwise. And the whole idea of a lot of the folks who are sort of providers of financial services and research, the goal is you're looking here, make you look there. Now I'll make you look somewhere else, and you're always running around. Okay, so no rabbit holes here. All right, um, let's do a few things here because we are in major, major, major feedback mode. Uh, I mentioned the phrase last week, inner circle. And as we announced last week, I'll just mention it briefly now. We've got a few weeks before it happens, but we had told Seeking Alpha, and they've communicated back with us that we're going to stop being an investing group leader as of April 30th. I believe we're probably within 2 weeks of, the folks in that service getting a notice from Seeking Alpha. They'll handle all that with you, the billing and the reimbursement, whatever. Okay. We continue to be one of the uh, faster growing finance publications on the Substack platform. But given what we're doing, and which is wonderful and much appreciated, I mean, the audience is certainly growing. We seem to have found a really nice home there for let's call it the range and the flexibility of our work. Uh, the but this site, which now looks, I think, a little prettier, I think, um, in the light. Again, you can go to dark if you want. They just kind of turned the light on this morning, if you will. And we're going to be looking for tons of feedback. I don't mind telling you that we are going to really try to simplify the look of some of this. It doesn't mean that people can't go and get, all the grungy data in the background that I have, but we also realize that I think people are going to, we don't want paralysis by analysis. We do not want to be the purveyors of that. I want to spend a few minutes today walking you through these portfolios. One of which I just wrote an article for Bar Chart on. I think they'll go through with it. If not, you'll see it as a post here. But I kind of talked about what I mentioned a few minutes ago about taking big risks with small amounts of money. I'm trying to give our followers and our paid subscribers, especially, a way to just say, let me click on that. I'm with the program. I got it. Okay. Can you give me a done for you or a pre-built? Okay. Uh, you can always create your own and start from scratch, and I hope to be giving classes, if you will, on doing that. I mean, that's the other thing. The more we hear from our core group, the people who are on these calls, in particular these live sessions, the people who've been with us the longest, the people that are in the chats, the people that send us an email from time to time. I mean, you're engaged, and that is appreciated more than you know. Uh, and so we are going to send something out probably the next 48 hours. And basically, it's going to invite you to be part of this inner circle. What does that mean? It means we feel like you'd be willing to give us your feedback. You'll also be the first to see everything as you still are. And when it comes to, let's call the full conversion within a few weeks, where I write for Seeking Alpha, but I'm not investing group leader. And you will really, with us, be operating between this Substack and this analytics site. Um, I think you'll be enjoying some generous discounts in membership compared to what the rest of the world's going to start paying for pretty soon. Because look, to be honest, I mean, I think my writing is worth something. We've got a couple of price points. I think this is worth a ton. Because there's nothing else like it. In fact, you'll look here. I don't need to show you the hieroglyphics behind it, but Portfolio Builder. Okay, this is basically my new go-to spreadsheet. I'm taking a lot of the things that I used to show subscribers I was working on, and it's all going into teaching people how to build their own portfolios. But if you don't want to build your own portfolio, then we can steer you toward that too. We're not doing it for you, and I'm not acting as a fiduciary, obviously. I mean, pie trade is if you copy trade there. But for the most part, like this is what is not being taught. People are not be they're being taught a lot of different ideas and a lot of stimuli and a lot of things that get them excited and make them click and Instagram, TikTok, the whole thing. But the one missing skill set, it's just going right over everybody's head, is how do you choose investments? Okay, that's one thing. But more importantly, how do you structure a portfolio? How do you put guardrails on it so that it is as aggressive or conservative as you want it to be? How do you make sure that you're not slipping up based on something that you've seen in the past, but you didn't put two and two together. And that's why the back tests on these things go back to the beginning of 2020, because you can see how anything you plug in here, as long as the securities go back that far, you can see how it did during the pandemic, how it did during 2022 and that morass, how it did in 2025, how it's doing right now, and you can get a pretty good idea. Okay, we want everybody to know their odds and know what they own as much as they possibly can. And it doesn't mean that you have to go and drill down constantly through 500 stocks and 4,000 ETFs to do it. So that, bottom line, is what this whole next phase of our project is about here, where you can read about it here. Okay, and that's that's easy enough. But then if you want to implement, or at least create your own or borrow ours, okay, you can do those here. And then obviously if you want to take the next step, you can click here and you can have it done for you. So you'll get this invitation to the inner circle, if you will. and we'd love to get your feedback. And if you're not, if you don't get that email, like if you don't get this by, I don't know, maybe Thursday, you know, um, it might just be that we missed you, our bad. Okay. I mean, we've identified, I don't know, probably 12 to 15 people, I would say, that are, let's say, our best customers in terms of giving us uh, feedback, interested, and they care about this. And if we're going to offer this to hundreds or thousands of people as time goes on, um, you can save us a lot of effort for all concerned by telling us what you think. Even as things as little as light versus dark. Okay, I'm going to skip around to some of the other stuff here. Those of you, I don't spend a whole lot of time on collars right now, and I kind of explain that in this article. If you're not a Seeking Alpha subscriber and you want to see this article, I think you can usually read one or two a month for free. But either way, if you want to see this, let us know. We'll make sure you get it. It was kind of a review of how I approach collars, in particular the dog collar concept, and the idea of what I call the forward collar. I won't go into a lot of detail here. I gave a few examples here. And again, I mean, I'm not, as you know, it's not like I'm running in to go buy these things and then tell everybody what I bought. Okay, I'm not the stock picks guy. Okay, but it was somewhere between gratifying and hilarious to see United Healthcare pop today. I'll say that. Um, anyway, that's the latest from Seeking Alpha. We have a new friend in the business, if you will. Um, he actually has a few different hats that he wears, and he works for a company, but is also has a couple of his own things here. The ETF Central, I believe, is him. He works for a company called Track Insight. But he came to me recently and said, "Hey, I had this guy that was doing these ETF launches, review this good, bad, and we'll see kind of thing on ETF shelf." Well, the new one, and I'm trying to figure out why it's not in here. No, I'm not sure. Um, but yeah, I am the new monthly guy on this here. It's great for me to go through the motions, see new ETFs as they come out. I kind of took the place as fellow Connor. Um, and I go in each month, and we kind of create this thing together, and we cover all the new ETF issues. We put some Roar scores in there. There we go. Okay. Here. So this is the format. He's got a great site with a really big following, a professional following for the most part. Um, and So, this is a table of all the new ETFs issued. I mean, this helps me, I will tell you, really figure out how much overkill there is in the ETF issuance business. So many copycats. On the other hand, you know, every time they have, let's say, something like this, I mean, there was one on Amazon already, but I want to see more of these inverse or maybe even leveraged long ETFs for individual stocks. I may put together a long short equity portfolio just using ETFs. So I go through this. And then since I mean, I'm not the biggest fan of Cold Stone Creamery, but I said to him, hey, why don't we do like a love it and like it, kind of thing, which I think are the two sizes at Cold Stone Creamery. Do you like it or do you love it? And I went through and and Roar scores in here, etc. Hopefully this is a good read. Kind of keep pace with what's coming out in ETF world, and I encourage you to check out ETF Shelf, and of course it'll be on our stuff too. The other thing I'm doing, because I mean, look, I don't toot my own horn a whole lot, but we put this out. I still cannot remember if this is in front or behind the paywall. I mean, this is, but either way, it's going to be part of what everybody will get to see who's paying for this. Um, this is where these things closed. These 10 as of the end of business today. So the cash down a little bit. Remember, what I'm going to do on every Wednesday is I'm going to look at this. I'm going to study the charts, triple check, and um, I'm going to make sure that these are telling me what I think they should be telling me. Remember, even the Roar score is not infallible. Okay, it can be stay a little too long. It'd be a little bit too late to the party, which it sometimes is. At market bottoms, and that's part of my style and part of my conservative way of reading charts. So, not a whole lot has changed here from last week. A little movement in this area. I think this one probably has ticked up just a little bit. So has the VIXI. So I'll study this tomorrow. And for the automated accounts, okay, if you just say, all right, I'm going to follow this, well, then you go in any day you want. It's for all the portfolios. If you like one of these portfolios and you want to track it yourself every day, frankly, intraday, anytime you look at this, it's going to be updated with the latest scores. So you kind of have to be your own portfolio manager and say, okay, every Thursday at noon, I'm going to check this, or I'm going to check it every day, but I'm going to make a move when things change. We've gotten some questions about tax ramifications, things like that. Good questions. But this is an automated portfolio. Uh, you can also automate it by, clicking, going to pietrade.com and have it run in sync in the same batch, if you will, with what I do on Wednesdays, which is to, trade my own account there, which the goal is to follow these 100%, but I'd say it's probably more like 90 something percent of the time I will follow them. The other reason I'm showing you this, and I really just started the research with a quick screen. We've added some metrics here. And if you look at this on a 5-year basis, okay, I mean, look, versus a moderate risk portfolio, pretty crafty here. It's quite quite a bit of return, but I would also note that the first time I noticed this, the 40/60, okay, not 60/40 stock bond, but 40/60 stock bond, 40 stocks, 40% stocks is actually has a negative Sharpe and Sortino ratio. What does that mean? The more risk it takes, it starts to not be rewarded for taking the risk. That's what a negative means. Negative, not great. Okay. And this is a great argument, I think, which I probably should write about, for how traditional asset allocation is literally getting less effective by the day. Just look at what's happening with bonds, right? Bond prices are going down as stock prices go down. Now, if they're starting to run together, so that maybe the war is resolved, or a 2 week pause or whatever, and the market flies higher, the stock market. Well, if interest rates plunge too, that's good and it's bad at the same time, because we don't want the if the markets are that correlated, well, then you probably don't need bonds other than buying and holding them. If everything is just that one trade, then you really don't have to make it that complicated. So I would prefer that stocks and bonds kind of move differently, but these traditional asset allocation approaches, not cutting it, haven't cut it for years. Um, what I thought was intriguing here, okay, if you look at the annualized return, remember what environment we're in, okay? But in the 5-year backtest return, about 6.5%. We just added standard deviation, and I'm pleased to say the standard deviation is actually a little lower than the return. Now, those of you who are not as financially wonky as I am, uh, having a standard deviation that is below your average return is not easy to do because standard deviation is kind of like saying, okay, if this is your average return, go one standard deviation in either direction. And that's how far from that average you will be about, let's call it two-thirds, 68% of the time. Okay, those of you who took statistics class or have read about this will know. Probably should write about this again too. It's been a while. So it's kind of like saying, all right, if my average return was about 6.5, about two-thirds of the time I'm going to be within 6% of that. And then if I go out further and I go two standard deviations, it's about 95%. You've heard confidence interval, perhaps. Okay. And if you go out three, it's more like 99%. Okay. So look, the bottom line is what it's telling us is it's really hard for this thing to lose money. And when it does, the losses are generally contained. Okay. Uh, in this case, to about a third of this. So I said, okay, it seems fairly rare to me, except again, I this is the modern incarnation of something I ran for decades back when I was in the client advisory business, and the funds that I ran kind of followed along, this mantra also. Yeah, the idea that the return will, hopefully be competitive over time, but the standard deviation would not be all over the place. Okay. Having a return of less than 3% that varies with a standard deviation of 8. Okay. I mean, if this is a 5-year return, any 5-year return, or another way to look at it is over the course of 5 years, you made 14%. But during that time, you had a drop of more than that. I don't want this to be lower than this. Okay. Or if it is, not by a whole lot. Okay. So these are numbers that are in sync with how I've managed money my entire career, which is why I love this back test, even though I don't like a lot of back tests. But that made me think, what, how difficult is it to produce a return of, let's call it 6 to 7% with a standard deviation over 5 years of about the same? And I'll leave off here, but I started with, I didn't just do US ETFs, I did US mutual funds as well. So we're looking at uh, 31,000 securities. Okay. Again, I just started with this, but I've already narrowed it down to 126. Okay. So I think you can appreciate, look, it's not easy to produce these types of numbers. I am not going to win a contest or a competition where it's the highest return. Okay. And by the way, we're gonna have to take a look here. I just noticed this. I told you I haven't looked at this yet. Okay. Interesting. I just heard about these for the first time. A lot of these event-driven mutual funds, okay? I'm not that familiar with these. All I'll tell you is I wonder how these securities are being valued in an era where, if you haven't read or heard about it, there's a lot of trouble in private asset, private equity, private credit land because they don't have to go and every day say, um, you know, what's the price of my security on the open market? Uh, so I'm glad I touched on that. Come back with that maybe with something for next week or maybe even in the daily. Um, okay, so that's the whole bunch of it. If you have questions, pop them in the chat. Otherwise, I'm going to give you what I hope is a quick and dirty tour of uh, this section of the site, the My Portfolios section. Um, we'll have more, but a lot of the good ones are here, and we're going to really be focusing. Okay, I mean, look, we know that people like the watch lists, which is great. Okay, um, you can create your own portfolio, which is also wonderful. And we've really kind of put the step by step in here. I think the my friends at PieTrade have done a phenomenal job with with that part of it. I documented the stuff, but I really like the way they express it. And this also, by the way, key area where we need people's feedback. Okay, this makes sense to me. Sure, I created it, but if you're going through, I mean, the best thing you can do for us is scour this site, every inch of it that you can, and say, "Well, I didn't understand this," or yeah, you don't have this. I mean, just let us know what else you think. If you're able to take the time, it is so appreciated, and we'll give you a formal invite to do that, and also prepare you for sort of the onboarding to this, because most of the world is most likely soon going to be able to do something like punch in 5 tickers a week, and after that, it's going to be okay. Come back next week or pay for the service, because we really do think we have something here. All right, so we've covered the 10 ETF a bit. This is the original recipe, to paraphrase Colonel Sanders. Okay. Now, I did notice this, okay, and I haven't checked it yet because this really happened, I think, this afternoon. Something happened to up the SPY to a 40, okay? It was down around 20 for a while. It just jumped to 40. I mean, 40 is not 70, not even 60. But we'll see if in all this frenetic activity. I mean, I generally don't trust when the market, kind of goes up and down, uh, gyrating like this. I mean, we've been in, see, we've been in 6 months of this. Matter of fact, let me go back. Okay. You tell me, is there a pattern here? Not that I see. Matter of fact, if anything, with my eyeballs here, okay, what I see just looking at this, not a technical chart, but I'm seeing that, okay, there's an old expression in technical land where support becomes resistance, and we're a little bit above that level right now. But let's see how many times this happened. If the market tends to hit trouble here and here, once it gets back to that level, it is more vulnerable. So we'll see. We'll see what caused this to jump. I'll have to look into it. My guess is it's probably because, remember, the Roar score is smoothed. Okay, it's smoothed over about 10 days. So what's probably happened here is this little bit of near-term jump is now being reflected because the moving averages and stuff like that are at least less bad. So I'm going to call this less bad for now. All right. Now let me go back to the portfolios. Hopefully, with each passing week, I too will learn how to whip around this thing pretty well. So we know SPY bill, we benchmark it to AOK. We benchmark the 10 ETF to a moderate risk portfolio. I'm not about like beat the S&P. Okay, there are some portfolios where the goal is to try to beat the S&P. I'll show you those in a second. But these two, I mean, this is a moderate risk portfolio. We probably should put something in here that kind of says aggressive portfolios, moderate risk portfolios, that type of thing. We have deeper names than that right now, okay? This is a conservative portfolio. Why? Because the Roar score is a risk management measure. It's not about Uh, it's not a rating system. Okay, it's how much risk. So we created another one here, which is very similar. The only difference is uh, it adds one key item. That item is VIXI. And remember, behind the scenes, the part that you don't see is there are upper and lower limits to what these can be. I think we're probably going to keep that under wraps. Um, People can go because again, it's one thing if you're copying the portfolio, but if you want to take something like this and just try to create your own version of it, have at it, have at it. So all we did here, okay, and I would have done this a couple of years ago, but frankly, I didn't know if it would confuse the heck out of people. Okay, this is the same spy bill that we know and love, except that when the market really starts to look ugly, why limit yourself to cash when you can also throw in a little VIXI? VIXI, as a reminder, is long volatility, is long the VIX index. Okay. And, it can go, it can't go to 50% because that would be downright dangerous. Okay. But it makes it so that now these two work as a little long short combination, or shall I say, a long and disaster hedge combination. So the two ETF portfolio, the original recipe was I own equities and whatever's not in equities, I own cash. Well, the next step in the evolution, if you will, as a simpler style investor like I try to be, is to say, all right, I'm going to have those two. However, when the market really sucks, I want to go a little bit deeper because, hey, maybe, and I have not looked at the details in this, but it's not out of the question that the market could fall and this portfolio could go up. And you can do that with SPY Bill, but it's so minuscule, I mean, what is in 3 months, you're lucky if you make 1% on T-bills, okay? This can go up rapidly. So what's better than SPY Bill if you are willing to take a little bit more volatility on because it can get trapped sometimes? It's doing this. And again, this is not a compare against the S&P 500 type strategy. If it were, then like anybody who says to you, "Oh, but I want to keep up with the S&P." My response: buy the S&P. Okay. Buy the S&P and I don't know, buy call options on the S&P, get a little bit of extra boost or buy if it's all ETFs, you can buy SPY and you can buy SVXY, okay, which is the, a little bit of a booster when VIX goes down. I mean, there's a million ways to do it. That's the point. That's the point. Okay. So, we're customizing the structure. Um, it's almost like when you move to a new construction neighborhood, right? And they have the models for you, but then you can tailor the model. It's not similar to that. Okay, so we've got that in there. What does that do to the numbers? Well, it does allow you, again, we're using that same benchmark because this is just supposed to be a different version of 2ETF. Okay. It does boost the return a little. It also boosts the drawdown a little bit. Okay. So you're going a little more risk, a little more return. Um, but I would be interested. I'll have to look here. Um, I don't think I'll spot it right away, but I'm looking to see. Yeah, okay. It's a miniature version, but this is exactly what I was talking about. All right. There's a lot of ways I know to make money in down markets. The 10 ETF portfolio is doing that pretty nicely this year, but I'll be curious here, okay, on the fly. So, yes, AOR is down, the SP is down a few percent. All right. Can you make money in an up market using only basically two ETFs and cash? Yeah, you can. And I'm curious now, since I opened that can of worms, if I go back here and see, how's this one doing? This is why one of our enhancements, I think, is going to be to put all this on one page. Aha, you see? Okay. So when it's SPY bill, even with the low score, yeah, it's beating the S&P. S&P's, I don't know, 4.5, 4, 5, something like that. Okay. So it's doing better than that, but it's not beating AOK right now. Um, whereas the other one is. So that's a good little mini example. Of of how that works. Okay, so let's go through the others, and I'll probably focus more on these next week. There is what I call cutie pie, um, sort of a tip of the cap to my friends at Pie Trade, and I said, well, wait a minute. One of the simplest ways to invest long short, remember trying to use just a few securities here, is to take the Qs, because let's face it, the Qs represent a lot of SPY and vice versa now. So I use the Qs. I will use not bonds. Most people like stocks and bonds. Well, I'm saying, well, wait a minute. The thing that can screw up the Qs might be higher interest rates. This is how I hedge higher interest rates with TBF. So you can see I'm taking little subsegments of the 10 ETF portfolio and creating little mini segment versions of them. Because, like I said, I don't know if a few years from now we're even going to need 10 in the portfolio. Okay. And for a lot of people, the best way to start down the process is to say, okay, I'm going to open up a small account for myself and I'm going to put this simple portfolio. And then I'm going to have another one. And I'm going to have another, and maybe I have four or five. And I'll watch them all work. And as I get comfortable with it, now if I want to start, you know, getting sort of bigger, dollar commitment and all that to this process that I've created over all this time, then you're doing it in baby steps. The nice thing is that with this one, again, same thing. The rule with all these is, as you see here, portion is allocated to build defensive holding to provide stability and reduce volatility during market downturns. Um, and again, it's the ROAR score at work behind the scenes. Okay. Uh, that's I have to say I hadn't looked at these numbers yet either. But I think this originally when I did it is why I said, you don't need that much. Okay. So I have to say, uh, pretty spicy, huh? I mean, remember, okay, let's start where I always like to start, which is, what's the worst thing that has happened? Well, since the beginning of the pandemic here in 2020, and that's when a lot of these drawdowns were. Well, remember, the S&P flash crashed 34%. This never did that. Came in much better. But over time, and again, this is for the people that maybe don't think quite as devout as I do about risk management and all that, and say, hey, the market's always going to go up over time, et cetera. Great. So you can actually take, in this case, historically less risk than the broad market by using the Qs instead of the SPY. If that continues, if the Qs continue to be the leaders, AI trade the whole thing, and you just have this little bit of income hedge. Okay. I mean, my job is to try to figure out stuff that works together, like like the chef of a restaurant, if I may. Um, we have all these ingredients. We can get other ingredients if we want, but let's try to come up with some dishes that people will like. That's what I'm doing basically in Rob's kitchen. You don't want me in the real kitchen. Dana is an amazing cook. I am right up there with Charlie Brown. I think I can make like popcorn and toast or something. I think that's what they said in one of those Charlie Brown things. Okay. But you can see, look, there's some pretty mambo returns here. Okay. So it's kind of like, you're saying there's a chance. All right. And look, these are the ones that this was the first round of cuts, if you will. Okay. Um, and I'm not trying to dispel my history as a risk intolerant investor, but look, I mean, Once things settle out, what I look at a strategy like this, say, okay, I'll put 5%, 10% in that and just let it go, just let it automate. I mean, that's why we did this. Okay. So you can check all that stuff out. That's Cutie Pie, um, only made possible by Pie Trade. Go Big or Go Home. I just wrote about this for Bar Chart. That article will be out in the next day or two if they're good with it. And again, okay, so why is this called Go Big or Go Home? Because I'm taking S&P triple leveraged on the long side and my least favorite major asset class, small caps, TZA shorts the Russell 2000. I just believe that secularly, small cap stocks are going to really suck compared to US large cap and probably versus non US, especially once the dollar takes a hit, but it's not happening yet. So here, I guess we compare to both these indexes. I think S&P is probably the normal benchmark. Okay, this go big or go home, right? I mean, there's a major decline there. Okay, there's also a lot of upside. In fact, what I did in the article for bar chart, because it wasn't about this strategy, it was about using triple levered ETFs. Now, I defined that pandemic period as like, I want to keep it in there because who knows if we get something that market wise is that crazy again. Um, but since that time, okay, and then we had the 2022, and that happened like every 40 years, although maybe it's happening again. Stocks and bonds going down together. We'll see how long it lasts. In 2022 is pretty rough. But if you look at, I don't know, the last 3 years here, and you got 23, which is a pretty good year, although the average stock did not do well. You see that the Dow has seriously underperformed the S&P during this time. And but here, you're going 3 times long, 3 times short, using the Roar score, cash as your buffer, et cetera. Um, and over the last 3 years at least, okay, short sample size, but same drawdown, and look at how much more return. So if I thought I could devote a portion of my portfolio to something that would have market level risk, but the potential to add 10% a year to it, or much more when you consider the Dow, okay? Yeah, the standard deviation is up there, but it's not 50, okay? You got people running around taking uh, taking these covered call ETFs, the yield max, and all the other stuff, and it's like the JEPI, and it's like they're taking so much risk, and you just don't have to. All in pursuit, what? Because they can get an income check, and then find out a few months later that they've lost 5 years of worth of income, and it might be a couple of years till it comes back. I've seen this. I've seen this cycle before. Okay. One comment, Don, QT Pie, nice, draw down a little higher than I like. We're going to be talking a lot about portfolio management on this show going forward. Okay. Portfolio construction. I'm not going to tell you what you should do, but I'm going to say this. I'm going to teach you how to think like a portfolio manager. Okay. One way, if you don't like, and here, let's go back to that one, QT Pie, and you say, hey, you know what? Uh, I would never, uh, would never actually. I'm sorry, this is not the one. Hold on a second here. I wanted to go to the one with the big decline. It was Go Big or Go Home. Hey, can you tell we're also trying to appeal to an audience closer to the Pie Trade Founders audience here? Okay, coming up with these cheeky names, but I think they are meaningful. They do relate to what we're trying to do. Max drawdown 47%. Well, I don't want a max drawdown of 47%. If I ran this portfolio, I would say, how much would I normally put into a portfolio like this? And then I'd say, all right, even in my worst day, in a small part of my portfolio, if 10% of my portfolio went down 47% peak to trough, I would not be happy. What could I live with? I don't know, maybe 5% instead of 10% of my portfolio exposed to this. It's all about the building blocks. It's not what the strategy does up or down. It's the strategy times the allocation. When I say position size, that's a code word for what I just described. Okay. I feel like we're getting a lot of pretty good coaching in here, which is great. So I will finish up with Dow 30 and pop stocks. And I'll just go through these quickly this week because let's face it, the stock market is a little bit rude. Okay. I will tell you from a personal standpoint, next to rebuilding my old core portfolio and in the form of what we call Roar 10 ETF model, that was the number one I wanted to get in the hands of everybody who is a paying subscriber of what we're doing. The second thing I wanted to get in their hands, other than the simple two ETF stuff, okay, the more sophisticated, I've always wanted to run a portfolio where I took the Dow 30, I own them all the time, but based on my charting, which I can now say the Roar score, okay, apply the Roar score continuously to all 30 stocks and let the portfolio sort out the rankings, not from 1 to 30, but generally speaking, what we do here is we say, okay, if it's the allocation range might be between this and this. It's a very wide range. This is the neutral range. This is the top and the bottom, and it will allocate within there. So I'll show you. We didn't put a hedge in here other than the cash, I believe. Uh, yep, I think that's it. Yeah, just the cash. Okay. Now the cash was pretty high before, so I do wonder if Roar is maybe sensing something adjusting here. But remember, it's 30 stocks. Okay. Generally speaking, these things are allocated 2, 4, 6, 7% at a time. And that's what it does. Okay. This is giving you the reconfigured Dow index with a little bit of spare cash because there weren't enough bigger ones. Okay. I notice here there's a lot of 4%ers and there's a lot of 2%ers. There's nothing above 4%, which tells me you have a lot of sort of, moderate level Roar scores here. Okay. Moderate and weaker. All right. But it's the same Dow. And so what would we benchmark it against? Well, just buying the Dow. And when I saw this, I was like, oh my gosh, we got to get this out, quickly. Okay. Because you can see, look, it doesn't have an inverse hedge here, but it's still protected pretty well during the crazy pandemic. And generally speaking, has really kind of trounced the Dow. And again, look, the Dow is a little bit easier benchmark because it doesn't have heavy weights to the AI trade. Okay, but again, okay, look, these are not meant to be necessarily viewed individually. You can combine them. And so it's just like, having buckets. It's a product set, if you will, but that, our subscribers can use how they like, and they can work with me, not to tell you what to do, but to help you figure out what you're trying to figure out. And I can't help you put it into English because I've done this for 40 years. So, uh, yeah, I wouldn't expect to beat the Dow by too much in a max drawdown type of situation. I really wasn't expecting that Roar would be that good at the stock level because, frankly, I think it's better for ETFs than stocks, but it's pretty good for certain stocks, huh? I mean, that's quite a spread over this. I am, and I'm curious here to look at the annual returns. Okay, 2020 was the year we fell, and then it had a snapback. Okay, so beat the Dow, even with the Dow, a little better in a down year. Beat the Dow nicely, beat the Dow nicely, even with the Dow. I'm good. I mean, this is doing what I always wanted to. When I say always wanted to, I mean like 15 years I've wanted to have a model like this that I could offer, but also that I could use myself. And there's and look, I mean, if something broke in this and all of a sudden the Ruhr score was backfiring all over the place, there's ways to hedge this. And one way to hedge it is just not to put that much into it. So, it's all part of a learning curve here. And obviously we need a cooperative market. And the last one, pop stocks, 10 very uh, popular stocks. I kind of curated this list myself by taking the Mag 7. And then let's see, we added Lilly, we added Broadcom, and we added Netflix. The rest of it is Mag 7. So this is the Mag 10. Now, this one, okay, uh, is much more along the lines of don't chase these things. Okay. And so as you can see, I mean, this might be a good market statement to kind of wrap up the show this week. I mean, there's a lot of zeros here. Okay. And Apple, I mean, yeah, it's in the portfolio, but I think Apple's off a few percent today. At least it was until late in the day. Okay. So, I mean, this is 75% in cash. So this actually has a tighter hedge to it. Um, and as you can see, it helped a lot during this period. In fact, let me just see here. This one only goes back to 2021. I'm trying to remember why. It might be. I am not sure. I will check. I will check. But again, from a risk reward standpoint, going back, 4+ years, uh, half the downside is about now. Look, you would expect that these things would do pretty well because this is Mag 7, right? Um, I also think that potentially it could be misleading. We'll see how it turns out because Mag 7 has done so well on the downside as well. But let's see. Let's see if it passes prologue and these giants continue to go. We wanted to have something in this strategy mix that at least could give people who and think people of all ages, but especially younger folks, okay, these might be the only 10 stocks they know if they even know all 10. And as a result, giving them something to say, okay, hey, these, all your favorites are here, but we're not buying and holding them. We're not day trading them or swing trading them. We are applying Roar to these 10 and saying, if it doesn't look pretty good, let's try to get the rips and avoid the dips, as they might say. Sometimes you end up 75% cash in that portfolio. And so that, my friends, is what we built here. And yes, we take requests. I can't say we'll build every one that people ask for, but feel free to throw any ideas you have. All right. And remember, these are back tests, okay? So it doesn't mean it's always going to turn out that way. The one I would say I probably have the most confidence in, no surprise, because I've run the money this way for so long. Just I put a little bit of a sort of fixed level to it and applied the Roar score is the Roar 10. Okay. Uh, all right. Any questions on this? Otherwise, I think that will make a pretty good tutorial, I hope. So thanks for sitting in on it. Any questions? Any feedback? Any comments?
Yeah. Hey, Rob, this is Don. I just had one. This is more of a pie trade question. I'd like to do most of my trading in my retirement account so I don't have to worry about tax stuff. And of course, with this, I'm probably not going
Yes.
to switch over, set up a new IRA with pie trade with Interactive Brokers, just for that. That would almost be a case where if it'd be interesting to have a way to kind of pay for a portfolio without actually using the pie trade for it or something. But I don't know. Just an idea. You see what I'm
So
saying?
let's see.
Yeah.
Copy trading that goes well, yeah.
Yeah.
Good question. So you're saying, right, trying to avoid opening up an account, but well, uh, again, I don't really control what happens once it gets over there. I mean,
Yeah. Yeah.
I own
Yeah. I
accounts there,
got you.
but the way we're looking to here, just get this off of here because we pretty much finished the recorded stuff. Okay. Um, Actually, you know what? I realize I shouldn't shut it off yet because if somebody's listening on the replay might have the same question. We are finalizing kind of the pricing structure, and I think the way it's probably going to work is that if you sign up for our, premium service, um, it's going to get you everything uh, to get it traded at a different brokerage firm. I don't think
Yeah.
that
Yeah.
is likely
Yeah.
to happen soon, but to be
Yeah.
able to get the signals, it might just be a matter of saying, okay, let me set myself a weekly reminder to go in. I can't, I give myself
Yeah.
all day
Yeah. Right.
Wednesday, but you could
That would be
go
the
in and
case
say,
that
hey,
if you could
Wednesday at
see.
noon every week, I'm going to just do what this says,
Yeah. Right. So in other words, if I could see all of the percentages at a point in time, then I could just do the trades myself, sort of. But it'd be paying for that
Mhm.
extra information or
That's
the
correct. Yeah, we
stuff.
we
That's what
went
I'm talking
back
about.
and
Yeah. Yeah.
forth as to what to do with this one, and I think we realized the common denominator is there are people that want my writing. Good. For $150 a year, almost certain to go up in the near term. They can, get the writing. Okay. If they want to go beyond the writing, work with me live, once a week and get everything that's in here. That's going to be the other level. And the folks that have been with us already, that are already paying for it at one platform or the other, um, they're going to really get seriously grandfathered in terms of the pricing because we can't think of a better way to thank people for sticking with us as we built this whole thing than to say you're going to get in at a fairly deep discount before we raise the prices. So,
Yeah.
all
Okay.
right.
Well, thanks again, Rob. Yeah, I've been playing around with a few portfolios. Hey, what if I use this one versus this one or whatever else? So
How
it's
else
it's
do you
kind of neat.
learn? How else do you learn, right?
Yep.
It's how I learn anything else. So glad we have that sandbox. I keep calling it a toolbox, more like a sandbox. Okay.
Yep.
All right. Thank you all, and we'll see you soon.